Hi, everyone. I'm Rick Bensignor. Welcome to the Internet Trader Show. Today is Tuesday, May 19th. And as we record late morning, we find the S&P has turned around from early losses to be up about 6 points. Crude oil, the expiring June contract, which literally stops trading today, is at 32 and change, but the active July contract is right now 31.70, pretty flat on the day. And gold has recouped a fair amount of yesterday's losses. June gold futures are at 17.44, up about $10 on the day. So today, as we take a look at our agenda, we'll do our general markets overview as we do each week. In our little trader education segment, we'll do a piece about how to up your confidence that a breakout to the upside or a breakdown to the downside is actually real and not potentially a fake. So we'll give you a little bit of information on how to up the odds that when you see one, you can count on it being one. And then, given how much biotech has moved up recently, of course, the news on Moderna yesterday, I figured let's take a look at the biotech sector. We'll look at the IBB NASDAQ biotech fund, and then we'll look at 10 names or so. These are the 10 biggest names in the IBB. So that's today's agenda. I wanted to mention to you that if you go to seekingalpha.com today, there's an interview posted there of me that was done last Friday, talking about several different markets with the host Aaron Task. I've known Aaron for probably close to 20 years, and he's been in a few different places as a journalist since then, but most recently joining himself at Seeking Alpha. And he reached out to me to talk about the market. So we recorded it last Friday, and we talked about the S&P, gold, and oil. So that, again, you can find on seekingalpha.com. As far as contacting me, it's rick@intheknowtrader.com for emails. And, of course, if you're interested in looking at my website and subscribing to become an In the Know Trader client, in that weekly report that I put out, which comes out Wednesday nights, I always do a deep dive into the S&P, the bond market, usually gold too, with some really important levels that you need to be watching as a trader. Plus, every week I put out a new ETF trading idea and track all the open ideas that we have. So these are, when I say that I put out a new ETF trading idea each week, it is not meant that these are one-week trades. Each week I give you another idea, and we generally build into a portfolio. This is not meant to take the place of your longer-term investments. This is more of a trading type of portfolio. So generally we're holding things weeks to months, not years. And so we update every open trade that we have each week until it's closed out. All right, let's take a look just as our weekly comparison of how the 11 macro S&P sectors are doing this week relative to last week on a year-to-date basis. Last week, 9 of the 11 ETFs that represent the macro sectors had moved more than 1% from the prior week. This week, there are only 4 sectors, and in this case, they all moved to the downside, at least 1% relative to where they had been versus the S&P last week. So technology is now outperformed the S&P by 12.8%. Last week, it was by 13.9%, so it's given up some of its outperformance. The other ones are less severe changes, or actually, I guess, similar staples. Just barely beating the S&P at this point for the year. That's down over 1% from where they were last week. Healthcare came in over 1%, now up about 7.9% from over 9% last week. So that's given back some. Utilities, financial, still on the downside this year, as is real estate, but REITs got hit this week kind of hard versus the S&P. Now down 7.55% versus just about 5% last week. So they got kind of hit this week. And that's not terribly good for us, because One of the trades we have on in the no trader is a pair trade using XLRE, and we actually have it paired against financials. And so seeing this tells me that in the last week or so, that trade is not working well, but it's something we intend to hold for a while. All right, let's take a look at some charts. Oops, here we go. And we'll start with the S&P, just with a few things on here. But as I've said before, I've designated areas here where I will be doing some more significant portfolio adjusting. So as we get towards 3,000 and above, all the way up to about 3175, I'll probably be a net seller into that area, with the expectation that we do not make new all-time highs this year. At the same time, to the downside, as we get under 2,600, I'd be a net buyer into that kind of green shaded level, and that goes 2,600 to about 2,490 or so. I am in the camp, and I've made it fairly clear in lots of comments that I've made publicly that I actually think we could spend the rest of the year within the range that we've already seen made this year. So we will not take out new all-time highs here up from February, and we will not likely take out the March lows. So I kind of suspect that we trade in this range, and of course, I could be wrong. I am, as best as I can tell, out of consensus with the street, because most of the street is either quite bullish or quite bearish. Last week on I guess it was CNBC, and I'm not sure if it was some other places too, some big hedge fund managers were talking about how bearish they are, and that this is just another accident waiting to happen, and that not only new lows will be taken out, but that this is just a terrible time to invest. But there were a couple on the other side of that trade saying that stock valuation is actually quite favorable. And knowing that the Fed is going to backstop any major declines, similar to what we called a few years ago the Bernanke put. Now it's Jay Powell running the helm, or at the helm. But we kind of get a sense from Mr. Powell, especially in the 60 Minutes interview, that there's plenty more that the Fed can do if they need to, and that therefore the bulls say the market's just not going to make a significant decline from here. The Fed will backstop any major decline. So there are a lot of bulls out there calling for new highs and well higher in a couple of years to come. I'm actually thinking that there's a very good chance we don't do much. We'll trade all over the place, but that we don't take out the highs and we don't take out the lows. And that's my call actually from now till the rest of the year. And it's possible it could extend another year. And I think of that in terms, and let's see if I can look at that on this chart. Okay, I actually can. So let me take off. Okay, so if we were to look in very simple terms, okay, so this is what you would generally call an expanding pattern. So from this high in January 18, we sold off, right? That was the early 2018 decline. We come back and make new all-time highs. This then sells off into December of 18 and took out the lows and made lower lows, only to turn around and again make new all-time highs and keep going to make the current all-time high. Then we sell off on all this COVID news, and we take out the December 18 low. As best I can tell, this is the midpoint of an expanding pattern that ultimately will probably be a diamond-shaped pattern. So if I drag this forward and I think of the down move this year as kind of the midpoint, then it's very possible in the future that, you know, we kind of make lower highs, and off of this low, we'll make higher lows, And this could last, for quite some time, where we're just simply into this pattern. So that's what I'm thinking, and I don't see anybody else on the street really calling for something like that, because you really have mega bulls and mega bears out there. And I kind of think that there's a real good chance that the range we saw this year stays the high and low, not only through the end of the year, but possibly even into next year. So that's my call on the S&P. Let's take a look at gold. We're going to look at a very long-term chart here. Nothing much has changed. You can see the breakout came above 1375. These purple lines in here, choose any one of them. I kind of just picked the middle one. And we had a measured move to 1700. We stalled there. We pulled back. Then we broke out. And in the last couple months, you can see last month in April, we got up to basically very close to the highs that were the last high. There's a triple top here. So after the all-time high was made in the 1920s, I don't mean the years, the 1920s, I mean the price of gold at 1924 is the highest futures ever traded. You had a triple top on a monthly chart. And those go from, I think it was 1793 or so to 1805. So my guess is that we spend a little more time here, and ultimately we do break out towards the upside. And my thought is that if we get through 1805, the all-time highs are not going to stop us. So I'm thinking that if we can break out here, this thing still rips to the upside. If we halt here and we can't get through and we break underneath 1662, then you have a chance to spend some more time in here. And I'm not looking for this to be simply a test, let's say, of all-time highs or anything near there, and that we fall back. I do think over time the fundamentals are very good for gold, and that that market will move higher over time. So, that is an investor's type of market. The GDX here recently broke out. We talked about this before. We've been telling people you want to own these stocks. You are getting closer to some near-term targets here in the upper 37, kind of, the 37.5 to 36.5 range. So we are getting and reaching some of those places. But if you look at this multi-year rounding bottom in GDX plus the flush out, it got just before it turned around and actually made its truer move, right? So this is the COVID sell-off where they took all risk assets down, including gold and gold stocks, only to come storming back. I think this has way more to go on the upside. And you're talking about all-time highs up here from 2011 in the 60s. So I think this really has room to go. So gold miners, on any weakness, I think you want to be a buyer. And let me finish up this in looking at the 10-year. And this is where I'll also talk to you about how to up the odds that a breakout is potentially a breakout. We'll use this, and we'll actually look at the IBB chart. So what I've been telling you and clients in general is that yields need to get above 76 basis points on the US 10-year to break out to the upside, which is the same thing as saying 7.6 on the TNX chart. And generally what I want to see is qualified and confirmed close above. So qualified and confirmed is simply a reference tool in order to up the odds that a breakout above any particular level that you're looking at or breakdown has a better chance that it's a real one. And so if I know that getting above this 76 level in TNX is a potential breakout that measures up to just about 98 or 98 basis, 9.8 or 98 basis points as an initial target, I want to have some clarity that getting through this level, this horizontal green line, is actually a real breakout. And before I even bring in the element of the cloud here, which now makes it a lot murkier, because as time has gone on and the cloud has moved down, the bottom of the cloud for yesterday, today, and tomorrow is kind of the same 76 level. So just as I potentially break out, I also have resistance from the cloud, which is still going to make this level tougher to play. I'm not saying I wouldn't possibly be a buyer if I get a qualified and confirmed breakout to the upside, but I'd have. I wouldn't put on as much size because I know that I also could be buying close to a top. But let's look at this conceptually and what DeMar kind of came up with. And he's even altered the rules on this as time has gone on, but I'll give you the basic rules. If you want to get a breakout above a horizontal level that you kind of have identified as resistance, then it would make sense that the bar before you break out, you want to see sellers show up against that resistance level. So people are still playing that level to be resistance. As compared to, let's say yesterday, where you got, if yesterday had closed above this bar, not above the bar, above the 76 level, that came on a day that saw strong buying, and it followed a day that had buying because you had an up close the day before, which means the last couple of days people have been buying, in which case breaking above a level is actually has less chance that it's real, simply because it was preceded by buying before it. So the way he thought about this was, if you have a down close, which looks like today the TNX will close lower on the day from yesterday, then you had sellers show up here against the resistance levels, such that if tomorrow you closed above 76, you at least then have a qualified breakout. It's qualified because today was a down close, meaning that you have sellers showing up against resistance. More people potentially on the wrong side of an upside breakout. So one of the things that he said as a way of helping qualify a breakout is to see price action in the opposite direction, the price bar before the breakout occurs. So in this case, if the TNX, we're seeing sellers come in today such that if tomorrow closed above 76, I at least know that I have some people who are on the wrong side very recently, meaning the prior bar. If tomorrow closes above 76, then now you have a qualified breakout, but is it confirmed? How do you confirm the breakout? Well, what you'd ideally want to see, and it doesn't always line up this way, so this methodology doesn't always work, but think about it from, if you have a breakout to the upside, what would really tell you that that breakout is real? Well, what to me I'd want to see is a gap up the next morning, which means buyers are really coming in, that it truly is a breakout. And I'd want to take out the prior day's high, and at a minimum. So if we close down today and tomorrow closes above 76, which is our reference point, that's this horizontal green line, which is the propulsion level. And the next day, TNX opens higher, so I want to see a gap higher, and it takes out the prior day's high, which would be tomorrow's high, right? So now we're talking a day after tomorrow, which is what today's Tuesday. So Thursday's open, we'd want to see gap up from Wednesday's close and trade higher than Wednesday's high. Then you kind of have confirmation that there's real buying that came in overnight. They're pushing the price higher, in this case yield, and you take out the prior day's high. That's a qualified and confirmed breakout to the upside. It ups my confidence level that this is really a breakout. Now, not all breakouts or breakdowns end up going that way, such that sometimes you miss a move or you don't have this as the confirming factor. But I know that it is one of the ways that helps up my feeling that what I'm doing is correct. You can even take that another step. So if we have down close followed by up close above our reference level, followed by the next day gapping higher and taking out the prior day's high, I could even wait for that, what would be in this case Thursday's close. to make sure that I actually close above tomorrow's close, meaning having an up close. Because sometimes you might gap higher, take out the prior day's high, and then close down on the day. Well, that to me is not really a breakout. You shouldn't close down on the day. A real breakout should go in the direction of the breakout. So you can do this in multiple levels of how many rules you want to put in. But as a minimum, what DeMar came up with is you want to see a move opposite the potential direction of a breakout or a breakdown the day before or the bar before. If it's a weekly chart, you actually get that breakout. So that's kind of what I'm thinking. And in TNX here, we have the same thing. I'm kind of saying, I've been telling people for a while, 76 is the potential breakout level, but now we also have to deal with the cloud, and the cloud has nothing to do with DeMar's propulsion level. It just gives more to potentially be worried about, but also if we can get up into the cloud, then potentially the cloud acts as support on the way down. So I still may put on a position, I just would probably put on a smaller position. And that's kind of what I'm thinking. Otherwise, you've got 56 basis points as a pretty strong support line. You've broken out of this minor triangle to the upside, but you can see you haven't really broken out. So yesterday's looks like, breakout of the triangle, only to see today be a down close. I like the down close because then I would qualify a move tomorrow. Okay, now let's take a look at our biotech names. We've got about 7 or 8 minutes to go, and that should be good to get through. I think we'll get through our 10 names plus the IBB index. So here's the IBB ETF, and here's all-time highs back in 2015. This is a weekly chart. So last week we went above that level, but closed beneath. So for all the people who bought the breakout so far above all-time highs, as of right now, they've got a loser on. Now, if we want to use this as our reference level, notice what can happen this week. Today is only Tuesday, but right now we're closed in a candle. The close is beneath where we gapped open on Monday, but we're still above last week's close. Right? Last week's close is 132.25. If this Friday we closed beneath 132.25, then we had a down close this week. Therefore, if next week closes above the purple line, the old highs, the following week opens higher and trades above next week's high, you have a qualified and confirmed breakout. And again, you'd really want to see that close in the direction of the breakout. So I wouldn't want to see it end up having a down close on the week. But that gives you, and this was specifically from a writer, a subscriber's request to help clarify what is this concept of qualified and confirmed. And that's what it is. So IBB close to a breakout, made new all-time highs, but hasn't really broken out yet. And biotech's been on fire recently, obviously, given that so many companies are in the race to come up with a vaccine for the virus. You're going to, there's a lot of money being invested in going into this. However, if a virus actually, if a vaccine actually does get discovered and approved, the sector may take a hit. The company that comes up with it may do well, but all the other names may not. So IBB right now, to me, is kind of questionable and not something that I'd want to necessarily buy right here and now. I certainly would want to, at a minimum, see a qualified and confirmed breakout, I think, to have any interest on my part to get in. Otherwise, this move from 95 to 135 on a percentage basis is pretty big, and I'd want to at least, look for buying somewhere lower than necessarily buying here and now. Let's take a look at the stocks now. We'll try to get through as many of these. Here's Gilead, biggest name in the IBB as far as weighting. Again, a weekly chart. Notice that some of the weekly 9 counts, the setups have been really good while we've been in this trading range. Bottom here, which actually in that 9 led to this 13 low into a 9 high. Ultimately at 9 low and 9 high back to the bottom of the range, and then we break out to the top of the whole range. You're in the middle of the range now, no particular edge in trading this name. So I would think as we look through other names, we'll find something that has a better chart. So let's now take a look at AMGN. Clearly a better chart, not within a range, but has a longer-term upward bias. You can just see this over time, but like many biotech-related names, these are very choppy type of stocks, or in this case, it's an individual stock. 9 high almost before the high in December of last year into a 9 bottom. And now we've come back, essentially tested the high. We've pulled back here this week. And again, we're kind of pulling down. So, excuse me, maybe I would take a look at something around here, mid-range, to potentially do some buying if you think the sector is going to do well. Otherwise, right here, having stalled several times at 245 this year and last year. I can't say that I'm in love with this name right now. Vertex. This one is the strongest name of the few that we've looked at, pulling back this week from the risk level. So there is a 13 in here, an aggressive sequential weekly 13, kind of similar to here, looking for exhaustion of trend. It worked for multi-months and actually bottomed into a 9 down in the opposite direction. These were buy signals down in here, which were perfect. These were pretty good sell signals in the past. So we do have an upside exhaustion signal that went right to its risk level. In other words, if you properly qualified and confirmed close above 293.03, it would tell you this signal is no longer good. We actually went right to it on this week's open. We've been selling off since. So this has a minor bearish bias for real aggressive traders. You'd actually probably be selling this and stop yourself out if it gets above. Regeneron, this name I actually own myself. I got it in at 3. I'm trying to see where this was. I played this 9 back last year. So I bought in here. I held through this. I kicked out half at 450, I remember, against these levels, and I've got the other half. In fact, now I'm glad I looked at it. I've got a sequential 13 here. This may very well have me lighten up in here, or certainly sell upside calls, because I haven't had a 13, a standard sequential sell signal, since back in here, which was good. That's a buy one that was very good. That's a sell one that was very good. So I'll probably lighten up here too. So I'm starting to get the feeling that a lot of these names, even though they've run quite a bit, are not necessarily looking so good. Here's Illumina, 13 upside exhaustion signal here, a week or two before the high, 13 on what was the all-time high back then, 9 bottoms for really good trades. We're on a 7 up now, so in the next 2 weeks, if we do a 9 up, which means we close above the close from 4 Fridays prior, for the next 2 Fridays, we close above the close from 4 Fridays prior, then you'll get a set of 9 and possibly a sale again. So another thing that shows up as a possible sale. We're running out of time, so I want to jump to Moderna, just simply because some of you may be playing this. Obviously, this is the crazy spike it's had. And there's just not a heck of a lot of history here for me to do much analysis on. Just see if there's anything. I mean, this is a parabolic move. And so this week we opened near the high. We're down here right now. I mean, count-wise, there's nothing. The only thing I could do is look at an aggressive combo. Where are you? You're here. There you go. No, nothing. So Moderna is in the news simply because, it is so far the closest to getting a vaccine. Honestly, I can't tell you. I don't see anything that I can rely on in either direction here. That is it for this week. I hope you enjoyed the show. I'm Rick Bensignor, and this is In the Know Trader.
Hey guys, Grayson Rose here with StockCharts.com. Thank you so much for watching. I hope you enjoyed this video. Remember, if you did, give us a like down below, leave us a comment. We'd love to hear from you. And most importantly, don't forget to subscribe to our YouTube channel for daily content from an